afternoon, everyone, and welcome to the 2024 edition to the Barometer Readings webcast. Happy New Year, everyone. I'm Pamela Hastings, Senior Relationship Manager at Barometer Capital, and joining me today is our Chairman and Chief Investment Officer, David Burrows. On today's call, we would be pleased to provide you with a brief macro overview, and of course, at the tail end of the conversation, be happy to address your questions. So hit us up with those questions on the chat or the Q&A via Zoom. And on this wonderful second day of January, with the markets posed to hopefully reap great rewards this year, I turn the conversation over to David Burrows. Happy New Year, David. Great to see you.
Happy New Year, Pamela. Well, from your lips to God's ears. Let's see how this year's goes. We're happy to be in a new year, 2024. We're coming off 24 months where the S&P didn't make a new high. So the question that everybody has coming into the year is what does the year bring? Fortunately, when we move from the end of December to the beginning of January, we come in with a setup in the market, lots of clues to show us what may happen going forward. And of course, the reason we do these webcasts is to look at the clues underneath the market surface, and compare that to what we're doing in portfolios to make sure that we're staying aligned with sort of market sentiment and market setup. So the opportunity here is to try and identify the key structural themes for the year, make sure that we take advantage of them, and hopefully avoid some of the pitfalls that are going to inevitably come with the market. Lots of geopolitical risks to think about. So we're gonna talk about that a little bit. We've got election year coming up. So why don't we right from the top, just as we always do, start with a really high level view. Our view has been since 2013 that we are in a structural bull market, and that hasn't changed. We've seen a series of pullbacks along the way, but it's basically been sort of 3 steps forward, 1 step back. Now, when we look at the last 2 secular bull markets, the 80s and 90s, and the 2013 through the present, we can see that in general, when we have been able to stay above the rising 200-week moving average, S&P has been in a structural bull market, and lots of little pullbacks along the way, but the market's worked its way higher. The thing we're always afraid of course, is getting into a structural or secular bear market, like the one we saw between 2000 and 2013, 2 dramatic and difficult long bear markets that we had to deal with in those cases. Both cases started out as a slowdown into a recession and then some credit issues, and that generally drove the second half of the sell-off. In the most recent sell-off, we started in December 2021, made a low in October of 2022, and have been able to hold a series of higher lows since. So as we sit today, and I'm noticing that I've got my screen isn't showing full period, but I can say that we're sitting at about 0.5% below the old highs. And of course, we always are looking at sort of being there for what comes next after you make a new high, because it tends to be you get a long run up in price that lasts 2 to 3 years. When we look at the S&P in the shorter run, this is the bear market through 2022 and the October lows, series of higher lows. And through that piece, each one of the lows we made was accompanied by a higher percent of stocks remaining in uptrends. So we're always trying to look at breadth in the market, look at the percent of stocks that are performing well, and things have generally been improving. As we sit, the S&P made a high right at the end of the year. We pulled back a little bit today, in particular in very large cap growth stocks. So we'll talk a little bit about that. But, this all really got going at the end of October this year, when we had, what we call a breadth thrust, where you had a 10-day period where the number of advancers versus decliners was about 10 to 1. And we know when we looked out a couple of months from those breadth thrusts, in almost all cases, market was markedly higher, an average of about 8.5%. This one actually turned out to be a little bit better, but when we look out 6 months or a year, In every case, the market was higher. So certainly that gave us a little bit of confidence. Now, one of the issues last year was that the 5 biggest stocks in the S&P made up a very big percent of the S&P 500, and the outperformance was dramatic. When we go back to November, as of November, virtually all of the returns in the market had come at the hands of the big 7 stocks in the S&P. Now, that doesn't last forever. And we talked about the fact that over the last 65 years, the equally weighted S&P, where every company gets an equal weighting, outperformed more times than the market cap weighted S&P, which is, of course, the index that we're always looking at. In fact, the equal weight was beaten by the market cap weighted only 25 out of 65 years. And in fact, the equally weighted tended to outperform. Now, there were certainly cases where the cap weighted did outperform. In fact, last year was about as much as it has ever done. In 1998, you had 15.7% outperformance. But following these years, you often had outperformance by the equally weighted. So we highlighted in November that for the first time since the Fed started to tighten, the equally weighted S&P started to outperform. What does that mean? It means the average stock started to perform better. The market was broadening, more stocks participating in the rally, less concentrated in just the very largest companies. When we look at the equally weighted S&P versus the NASDAQ 100, so even more concentrated in large cap tech, a distinct shift here. So it remains to be seen whether this will continue, but off the lows of yields back in 2020, the equally weighted S&P was outperforming until the Fed went into its tightening cycle. And through that period, we saw the NASDAQ 100 outperform until the beginning of December this year. So we think that's a significant character change in the market. We also would highlight that after 2 full years of underperformance by small and mid-cap stocks, they look to be prepared to break out versus large cap stocks. Another shift. So small mid-cap looking a lot more interesting. Certainly the equally weighted index or the average stock acting a lot better. And that's what tends to happen in a really healthy market. Now, the other big thing that we're watching, we've talked about the fact that US stocks have outperformed the rest of the world for several years since 2011. And in fact, the greatest outperformance on record. But interestingly, since the market made its low in October, as the US dollar topped out versus euro, yen, British pound, and so on, US dollar started to weaken, and we've seen strong performance in global stocks. So one of our focuses for 2024 is global equities. In fact, we're targeting a new strategy, specifically at large cap global equities, ex-US. But we've seen and talked about Japan outperforming for the first time in sort of 30 years. We've seen India outperforming for the first time since 2011. We've seen Mexico outperforming for the first time in close to a decade. And interestingly, here in Canada, yes, the TSX was in a range between 2009, really in 2020, and in 2021 broke out, certainly consolidated during the period the Fed was tightening, but it's made a monthly new high. So we're seeing a broadening of equity participation globally. We think this is really important. It's really good for investors. It creates other opportunities and chances for diversification. So one market that in specifically is not participating is China. This used to be the go-to for anybody wanting to go outside of the US. Certainly, relative performance continues to be very weak. They continue to have problems. Moving on to bonds, big picture for bonds. We saw a generational low in interest rates in 2020. We saw a very, very sharp rally in yields. This is the 10-year Treasury yield. If you look at it, sort of going back to 1981, it was a very significant trend change that took place through 2020 and 21. We have seen a couple of pullbacks along the way, and we certainly are seeing yields pull back since October. And while that certainly takes the pressure off of bonds, stocks continue to outperform bonds as an asset class. So when yields started to pull back, he said lots of people are going to look for opportunities to buy bonds here. In fact, stocks gave twice the return of bonds from the beginning of November to the end of December. So equities is the asset class that we really want to focus on. We talk about commodities. After a bear market that started between 2009 and 2011, we saw a low in 2020 and a nice reversal in direction. When commodity bull markets get going like stocks, they tend to go on for 10 years or 15 years. Certainly they consolidated during the period while the Fed was tightening. We broke out going back to July. This was probably the first asset that started looking beyond the Fed tightening cycle. And certainly we've consolidated over the last 3 months, but all of the moving averages are moving higher. We're trading above all the major moving averages, including the short-term ones. I think also that goes against common consensus that we're headed into some kind of economic slowdown. That should be bad for basic materials and commodities. This is probably the most under-owned asset class. In fact, investors sold this asset class all of last year, and it's the most under-owned it's been since 2008. So copper, for instance, after consolidating the Fed's through the Fed's tightening cycles, broken out to the upside. Gold, we've talked about at the end of the year. In fact, had a new closing high at $2,095 in the end of December. And Bitcoin is certainly strengthening. Now, this is interesting. It's not a big focus of ours, but we've talked about it over the course of the past year. We've seen a number of sort of crypto winters take place going back to 2010. When you came out, you tended to have big run-ups. We're watching this closely because, interestingly, when we compare Bitcoin performance versus the equally weighted S&P, every time you broke out from one of these periods, you had a long period of outperformance, and we did that in October. So in our macro portfolio, we do have a 10% weight between Bitcoin and Ether and have had now for several months. And this is a small piece of the portfolio, but something that we want to keep an eye on because certainly there's interest there, and we're going to see ETFs get approved in the next 6 weeks or so. So that's a high level view. We come into the year with a structural tailwind for equities. We come into the year for the structural tailwind for basic materials and commodities. We come into the year with bonds having struggled, but the pressure has come off by yields coming down a little bit and the US dollar coming down a little bit. So that's the backdrop as we come to the world. Now, we don't have to be everywhere. Our job is to target. Our job is to find themes that have a structural tailwind that can help us over the course of time outperform the broad benchmarks. We got to always watch for change. And I think important to see the equally weighted S&P start to outperform, important to see the global stocks are starting to outperform. And we always have to be prepared to play defense if the tools that we use to measure risk start to show an elevated level of risk. So our job is to be tactical. Now, as we come into the year, pretty fully invested. We got quite fully invested going through the month of November. We have small bits of cash here and there, but for the most part, the portfolios are positioned. Our strategy is very straightforward. As a reminder, our view is that 80% of return comes from being in the right asset class and then being within the sectors or themes that are benefiting from the structural change within those asset classes. We have to identify specific securities to use to target and take advantage of those themes. So we have our top-down model that drills down to look for specific neighborhoods that are seeing net inflows of capital. We have our bottom-up work that takes a broad universe of securities and drills down to companies that have the characteristics we're looking for, which are very simple: good getting better. Fundamentally sound businesses where we can see something changing for the better, driving acceleration in the underlying business that can lead not only to earnings growth, but multiple expansion as people recognize that positive change. So the portfolio is driven generally by our top-down themes, identifying securities within those themes, and that makes up our portfolio. Now, the reality is the world is constantly changing. And so probably the most important part of our strategy is having a very disciplined selling strategy. I think that in general, where people make their biggest mistakes isn't in what they bought in the first place, but it's in what they don't sell. So we run stop losses on all of our positions, and we trail our stop losses higher as stocks work out as we hope or expect. So just from a top-down perspective, we're always looking for areas where we're seeing an increasing number of securities participating in a rally. That's healthy. When we see deterioration in breadth or where the weaklings under the surface have started to sell off, that tells us there isn't enough new money going to work, but there's enough money leaving where the risk reward has changed. These are groups we want to avoid. We want to only look to add new positions in areas that are showing expanding breadth. There's no bear market in history that took place while breadth was expanding. So while everybody looks at index price, we want to look at breadth. So why is that? Let's talk about it. The end of October in Canada, in the US, and globally, for the number of months from the beginning of August through the end of October, the percent of stocks in uptrends had been deteriorating. The percent of stocks trading above their 50-day moving average had been weakening, both in Canada and the US and globally. Percent of stocks with positive weekly price momentum or upward trajectory had got to a very small number. In other words, almost everything had downward momentum. Percent of stocks making new highs versus new lows was a very low single digit. I mean, most stocks making new lows. And the percent of stocks trading above their 150-day moving average got down to about 22%. Between October 30th and year end, obviously a significant shift. As we come out of 2023, 64% of stocks in the NYSE are in uptrends. And that's been expanding steadily over the last 2 months. Percent of stocks in uptrends in Canada has been expanding. Percent of stocks globally in uptrends has been expanding. So our broad, big picture indicators are showing a broadening participation of more and more stocks. Again, that's a healthy environment. It means the market's ready to absorb shocks. The percent of stocks trading above their 50-day moving average in the US, just around 80%. So 80% of stocks trading above their short-term trends. Percent of stocks trading above the 150-day moving average is pushing high 60% range. So as long as these are improving, we're in a healthy environment. This number can get to 80 or 90% and stay there for as much as a year at a time. Just to put a point on that. This is a picture of bullish percent for the NYSE. This is time along the bottom, starting with 2013 to the present, and a percentage reading on the left-hand side. You can see that in the end of October, 28% of stocks were in uptrends, and that's been improving since. Recently, in the last 10 days, we exceeded the high that we saw in July. So that's important. We're making higher highs. Now, if we go back in time, you can see in 2020, 78% of stocks were in uptrends. In middle of 2020, 80% of stocks in uptrends. So this is important. I've got data on this going back to 1951. There's no bear market in history took place while we were in a column of X's, meaning percent of stocks is expanding. So we're in a healthy backdrop for equities. When we look at the sector work, at the end of October, you can see on the distribution curve where we're measuring the percent of stocks in uptrends by sector, the average sector had 24% of companies in uptrends. Because they're all in capital letters, it means that the percent of stocks performing well had been deteriorating. If we look at it today, it's a different picture. The average sector has 52% of companies in uptrends, greater than 1 and 2. It means that if we throw darts at the board today, we've got a greater chance of success than failure. But this can move a long way. It can wind up stacked all the way up at this end of the spectrum. You'll note that virtually every sector is showing expanding breadth because they're noted in capital letters. You'll note the companies with the best breadth, the companies with the highest percentage of stocks in uptrends, are economically sensitive: banks, builders, steel companies, capital markets, insurance, forest products, regional banks, business products, aerospace, semiconductors, machinery. The fact that these groups have the best breadth in the market tells us that there's very little chance we are imminently running into a recession. The market has a way of sniffing things out. Money doesn't roll into these economically sensitive groups just before the economy goes off the edge. So the market's giving us a signal. Now, at the other end of the spectrum, the most defensive sectors like telecom and pharma, healthcare, consumer staples are lagging. Now they've seen some improvement over the last 6 or 8 weeks. Every group has had improvement, but these are the leaders at the right-hand side. So let's talk about leadership. Now, you can't talk about leadership in today's market without focusing first on tech. And as many of you know, tech has been an important part of our portfolio since March of last year. But one of the things we always like to watch is relative price performance. And in the November and December rally, relative strength made no progress. Now, we've talked about the fact that the outperformance of large cap tech has been historic. And these things don't go on forever. There comes a point where people own what they want to own. And you can get to a point where things are too concentrated. So today, the XLK, which is the large cap tech ETF, was down just about 3%. That's important. That's a shift. Now, we talked halfway through the month in December about the fact that the top 7 stocks relative to the bond market had started to flag. I can show today the NASDAQ 100 versus the equally weighted S&P, so less tech weighted, made a significant reversal in the late part of December. And today made a lower low. So beginning of the year always brings some rotation, always brings some rebalancing. But we know that over the course of the year, large cap tech had a very significant outperformance, and we had been taking down our weight. Apple, one of the largest and most important companies in the world, we wound up selling in the 3rd week of November as relative strength was clearly flagging. So tough decision to sell one of the favorite companies on the planet, but we're happy to be out of it today. So this is a shift. On the other side, financials, which had such a difficult time through the spring of this past year, and again in October, started to show significant relative outperformance in the month of November. It was one of the first groups that turned higher from a breadth perspective. Insurance companies had been leading, but large cap banks started to perform better. Now, the one bank that we didn't ever exit was JP Morgan. And the reason is we have an affinity to the financials group, because when we look at pull the lens back and take it the big picture view, 2008 through 2020 was a secular bear market for financial stocks. No new progress. When a group's been out of favor for many years and eventually makes a new high, it generally means something's starting. Now, we rallied sharply through 2021 and through the Fed's tightening cycle because they're very financially sensitive, pulled back and consolidated. But look at the last 2 months. Boom, boom, November, December, and the start of January. On a day where the NASDAQ was down 3%, financials were up on the day. This is rotation. So JP Morgan has been a favorite of ours for the last 2 years. The relative strength versus the S&P has continued to improve, way outperformed the large banks, certainly even more outperformed the regional banks. It's the highest quality bank. It's the most defensive balance sheet. It's the best run. They spend the most money on technology. We're here trading within $1 of all-time highs, and relative strength is making new highs, so that's great. But beyond JP Morgan, we saw a significant uptick in Bank of America, which we added in November. Citigroup, we added in December. And the nature of these companies are that they have been under-owned. The dividend yields are attractive. The dividend growth is attractive. The multiples are cheap. In Canada, we added CIBC, we added National Bank, and we added TD. So I think that it's important to recognize change. This is value as a characteristic in companies underperforming for several years. We saw a reversal in 2022. This was the Fed's tightening cycle. And over the last 2 months, we've seen value relative to growth start to outperform. So it's important to recognize changes because sometimes the market gets very crowded in a small number of names. We want to recognize those sea changes so that make sure that portfolios stay in tune with the market. Outside of financials, industrials have been a strong relative strength group over the last couple of years, in particular defense, and that's something that we've spent some time talking about. Certainly, small cap industrials performing well. We'll see how they do over the course of the year, but certainly breadth looks pretty good there. This is materials. Materials, after going through the Fed's tightening cycle, broke out in the month of December. We think that's important. The steel sector broke out to new highs. Not very recessionary when that happens. Again, after a long bear market, metals and miners, after a long bear market, broke out, went through the Fed's tightening cycle, and have broken out to the upside. Timber and forest. Again, this is a group that is not expensive. It's a group that is not well owned. Commodities have the lowest exposure in fund manager portfolios since 2008, but yet they're starting to outperform. Important to recognize shifts. One of the poster children that we use for this theme is Rio Tinto. Rio Tinto, of course, is a company that has exposure to many, many different commodities, base metals, energy, and so on. After this, the bear market in the early 2000s broke out, pulled back, and then rallied 521% through the course of the next few years. Well, we saw a bear market from 2011 through 2020, broke out, pulled back in a similar way. Now we're breaking out of that range and headed higher. Very nice dividend yield, one that's likely to grow, one that's under-owned. We think this is a good exposure to have. Gold, we also talked about. This is the monthly chart. Had a monthly close above all previous closes. We think this is probably underappreciated because certainly it's underperformed for a long time. Another shift that's taken place. So when we look at materials, we think about the metals themselves, but we have to also think about building products. This is a ITB ETF for home construction companies and materials companies. Look at the relative outperformance. If we think we're headed into a recession, this shouldn't be happening. Energy's been contentious. It looks a lot like some of the other sectors we've been talking about. It's had strong relative outperformance since December of 2020, and certainly the resolve has been tested over the last 2 months. I do think it's important to give this a little bit of space. We took down some of our more volatile positions through the fall. But when we look at, sort of the best names, and Canadian Natural Resources is one I know we've talked about several times. Again, like Rio Tinto, came out of the last bear market, rallied 700% between 2003 and 2008. Now, it's been in a sideways market from 2009 through 2021, but now trading within a whisper of all-time highs. So dividend yield, dividend growth, low multiple, under-owned. We think this is attractive in a world where value seems to be coming into favor. So our job is to be in the groups that can get revalued going forward, not looking backwards. If we compare high beta SPHB, which is an ETF of economically sensitive companies, to companies that have low volatility or low economic sensitivity, we've just made new highs. So that doesn't tend to happen at the end of a move. It tends to happen at the beginning of a move. And again, that fits with the value theme. It fits with the theme of equal weight outperforming. We think these are important clues. It means that defensive stocks utilities, telcos, REITs, consumer staples, probably less attractive. They're underperforming relative to more economically sensitive. Last major theme, dividend growth. Dividend growth has been outperforming high dividend payers since midway through 2023. In fact, made a low before the market made its low in October of 22. Been making higher lows ever since. And again, broke out to new highs in the month of December. So what does that all mean? If we look at where our portfolio was in the middle of December, financials were our biggest weight. We had been taking them up versus the index, a significant larger weight. Technology was significant underweight versus the weighting in the S&P. Industrials were about 11%, significant overweight materials, and very low weightings in defensives. Fast forward to the beginning of January. We've taken our financials up further, 24% of the portfolio. Technologies come down to 17%. Industrial, we took down by 2% in order to move money to financials. Energy came down over the course of the fall, but still an important weight and important overweight versus the S&P. Continue to have very low weightings in utilities, real estate, communication services, consumer discretionary, and healthcare and consumer staples. These are the more defensive groups. These are the groups that we think multiples can expand in. These are the groups which we think are underowned. These are the groups that are more value driven. So things that we think about. We're headed into an election year. If we look at history back to 1950, the first quarter of an election year tends to be weak. We get a lot of questions about this. There's a lot of elections this year. There's one in the US, but there's a ton of them around the world. And that tends to lead to some uncertainty. Remember that the market is a machine. There's 1,000 moving parts, a lot of different things we think about, and front page news is what catches people's attention. But remember, the market's performance is driven by a whole series of factors, not one factor. And the market often behaves in the way that it's set up to behave coming into the new time period. So we think about this, but we also think about that bread thrust we saw in November. And when we look back to 1960, bread thrusts come at the beginning of significant bull markets. So we got that going for us. We know that we're headed into a period during the year, January, February, March, April, where we get the largest net inflows into the stock market. And there's $6 trillion sitting in cash. We know that the credit spreads bond investors are demanding to buy corporate bonds has been falling, which means they are more comfortable with credit risk of corporations. We know that we are now in a low volatility regime, which tends to take place during strong stock markets. We know that when the market had 2 big months to end the year, it's very bullish for the next year. In fact, if we go back to 1950, it's happened 6 times. And look at the next year, up an average 19% and positive 100% of the cases. And we know that their stocks have never been lower for the year in an election year under a new president, up an average 12.2%. So we look at the short term. We look at the way the market's behaving. But we got to take the lens back always to say, where is the opportunity? As we sit, we're within a whisper of coming out of a bear market that's been going on now 25 months. And when that happens, we know historically we got a long way to go in the market. So we look at the first day of the year, certainly weak, driven by the NASDAQ. Well, we're happy to have a little bit lower weight, or about half the market's weight. Other areas like financials were up on the day. We think that the market is in one of those periods where correlations are low, meaning some things do well and some things will do poorly. And it appears that the groups that we're in are in the strong camp. So if things change, we'll get more defensive. We got a history of doing that. But as it sits right now, we're pretty fully invested. We'll keep doing these every week. As things change, we'll talk about it, compare them to what's going on in the portfolios. But as we enter 2024, we're pretty optimistic. I think that we have an opportunity. The reason that stocks show good numbers over time is because after difficult periods, they have really good periods. And we think we're in one of those periods. So with that, Pamela, if there's any questions, certainly we'll try to answer them.
Absolutely, Dave. Thanks so much. Alejandro has a question, Dave. He says, Happy New Year. Would it be possible to know which function in Bloomberg, or could you reference the software you use to read the breadth of the market or any different subsectors?
Great
The
question.
the
So there's
charts, he really enjoys your webcast as well.
well, there's different places you can go to track breadth. The concept of bullish percent was started by a company called Chartcraft in Virginia in the 1950s. And you know, has been used by lots of folks. It does require some work. There's a really good provider called Dorsey Wright and Associates. You can find their website. It's a NASDAQ company. They have an excellent web tool that you can use, and you can do lots of interesting screening. A lot of it has to do with point and figure charting, but it's a tool that I've been using for a long time. So worth taking a look there.
Thanks so much, David. The next question here comes from an anonymous viewer who wants to know your hypothesis on the US dollar. How do you incorporate where you think the US dollar is headed in your strategies, and where do you think the US dollar is headed in 2024?
Well, as we looked at, you know, we got a reversal in the US dollar versus the basket of world currencies in October. The previous reversal happened in October of 2022. From a longer term perspective, it looks to me like we're seeing a shift. Now, let me just put some things together. First of all, when the US stops outperforming and global stocks start outperforming, it happens when the US dollar starts to weaken. If I look at, for instance, the Canadian dollar and the Australian dollar, they're very close to breaking out versus US dollar. Not happened yet, but it's something certainly worth watching. And the Canadian and Aussie dollar tend to go in sympathy with commodity prices and energy prices. Both of those, I think, look attractive based on our work. So I would expect probably the Canadian dollar and Australian dollar to start to strengthen, but we've already started to see a reversal. We saw a reversal in trend for the euro, and it looks as though we're seeing a reversal in trend in the Japanese yen. So currency, I think, really important. If that's the case, the history is that emerging markets and global stocks start to do quite well. If we look at the basket of emerging market currencies versus US dollar, it's also on the verge of breaking out. So I think that there's a lot of big changes taking place here. And our job is to try and set up before it happens or as it's happening, which is why we have the sector positioning that we have and the bent more toward value, the bent more towards small cap stocks, and a larger and larger weight of global equities. We've taken our our Go Anywhere equity mutual fund, and we've converted that to a global mandate ex-US, meaning no US or Canada. That's 60 positions. And again, when global stocks get going, they tend to outperform for as much as a decade at a time. So important to watch for those changes and not to look backward, but to look forward.
Thanks so much, Dave. That concludes the questions we've received this afternoon. So on that note, I will leave you with the final word. Thanks so much.
Well, you know, best laid plans. Market has a way of keeping us humble, so we got to keep watching for change, keep retesting our thesis, and as it sits right now, I think we come into the year positioned very, very well. Certainly the back end of the year last year was a bit of a barn burner, and I don't think people expected it. So we'll see how things go. But we do think the market's set up pretty well for this upcoming year, and we think that the position that we have is the right one. If there are questions we didn't answer, and you're a client or you're not a client, reach out to us. We want to have conversations. If you're too shy, we're certainly happy to jump on the phone and have a conversation with you. And if there's topics that we haven't touched on, send us a message and we'll try and incorporate it next week in our upcoming call. So thanks everybody, very much, everyone. I hope everyone has a great year. Hope everyone's healthy. And we look forward to talking to you. Thanks, Pamela.
Thanks, David.